Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, we're going to be discussing how you assess a good deal in multifamily. One of the biggest mistakes that beginning investors make, I think in any investment that they're making, whether it's stocks, bonds, crypto, real estate, they're all looking for a good deal. Well, what is a good deal? A good deal could be a good deal to me, but is it a good deal to you? That's really important to understand. When I first started out in investing in real estate, C properties, older properties, they were great. That was the deal for me. That's where I started. That doesn't mean that's where you should start. It all comes down to me when you're looking at investing to really create a foundation, but also to understand what your investment goals are. And I think in this video, I really want to dive into how are you going to assess a deal? What makes a deal a good deal? When we start out first by talking about our framework, the buy right, the manage right, and the finance right. If you learn those three pillars, you can start assessing deals. But I want to dive deeper into the pillars themselves. And this is probably going to hinge a little bit more on the buy right aspect of it, right? Because manage right, even though you should be looking at the manage right when you're looking at a deal, because, hey, there's this acronym that we like to say, ROE, return on effort. When you're first starting out, you don't mind putting a ton of effort into getting your deal to get repositioned and start making money. But when you've got 17 or 18 deals, or even 4 or 5, and there's this really good deal, you think, but you're going to need a lot of effort. It's going to take a lot of bandwidth. Well, should you go buy the deal? It's a maybe. Do you have the infrastructure or the time to handle it? You have to answer that question. So although it may seem like a good deal, is it the good deal, the right time for you right now? So when you're looking at it, the first thing that I want you to do when you're trying to assess a good deal for you, and you're getting into multifamily or you're in real estate, I think one of the most important things is the market. Let's talk about the market, because you could find a great deal you're thinking, and before I jump into like the financials and all that, oh, this is a great deal, but how's the market? And more importantly, can you assess the market? Can you get access to that market? When I first started out in New York, I didn't really live in a great market to be investing in multifamily. It was close to the city. Prices were really high. There was very little cash flow. So what did I do? I went and I chose a market on one metric, on cash flow. I didn't even look at any other metric. I wanted to make X amount of money per month to leave my job. That's what a good deal to me was. And I'm like, wow. I look back at that and I say, that was such a huge mistake. I ended up going into Rochester, New York. It was only an hour flight, so I could get to the market. It was easy for me to get to the market. And I did one thing right, at least. When you choose a market, become an expert in the market. Understand the demographics, understand the job growth, the population growth, the median income, the paths to progress of the market. I had learned all that in Rochester. Unfortunately, there really was no path to progress. The market was losing employment, had a lot of Section 8 housing, which is not a good or bad thing. I just wasn't built for Section 8 housing. There was no job growth, a lot of older assets. There was no appreciation whatsoever. It wasn't a great market. Now, if it was my backyard and I was investing in it and I was living in that market, it's a little bit different of a story. But I was literally choosing that market out of one metric, and it was just cash flow. I didn't look at anything else. So when you're assessing a deal, the first thing that you need to do is you need to select a market that you're going to feel comfortable in. And if you're going to be investing outside your backyard, you can't go out and select a market that's really small for one fundamental reason. If you're not managing that property yourself, it's going to be very hard to find property management. So when selecting a market to invest in real estate and multifamily specifically, I would say the ease of getting there, it has to be on top of the list. Who cares if it's 5% job growth? If people are moving in, rents are going high, the affordability, everything's wonderful about the market. If you can't get to the market, or it's going to take you half a day to get there to assess a deal, how good is it? Now, the caveat is if you've got boots on the ground or a business partner who lives there and they can assess the market and they can, be in that market and be boots on the ground, well, then maybe that's a consideration. That's actually what happened to me and Jake. Jake moved down to Knoxville, Tennessee. I'm still living up in New York. Although New York to Knoxville, hour and a half flight, easy to get there. But Jake moved to the market. And I said to myself, I like this market. Why? Prices were actually really low when we started, but that wasn't the only caveat. There was appreciation. There was population growth. There was job growth. There was affordability in the market, a very friendly business climate, really good landlord laws for landlords. A lot of that and the market was really favorable to me. So if you're looking at, say, in California, you're saying, well, I like the Atlanta market. It may be a little bit difficult for you to get on a plane from California, fly out to Atlanta, 5-hour flight, fly back, time zones. Can you do it in a day? What I did when I was in New York, getting ready to move and leave, I decided to select Florida, hour and a half flight, ease of access. And then on top of that, I like the market in Florida. I like the population growth. I like the job growth. So the first thing when you're assessing a deal, before you start underwriting deals all over the country, pick one or two markets that you like. One or two. Just focus on one or two. Become an expert in those markets because you can't underwrite and understand the value of a deal or the value that you can create in a deal if you don't understand the market that you're playing in. You can't compare deals in Jacksonville, Florida to a deal in Omaha, Nebraska. Different metrics, different returns, different ages, different vintages, different incomes and expenses, different cap rates. Pick the market. Now, the second metric that you need to focus on when looking at a deal, and this is important, it's the property itself. I'm often heard saying, don't fall in love with the property, the deal, fall in love with the numbers. Sometimes when you're analyzing a deal, you have to look at the property and say, well, I'm strictly looking at the numbers, but this deal, this property doesn't look so great. And that's what happened to me in Rochester. I fell into that trap. I was buying these assets for $60,000 for a duplex. They're $30,000 per door. Rents were $650. So if you're doing the math, it's $8,000 a year you're collecting in gross rents. After 4 years, you've collected over what the house is worth, $30,000. Looks great. Awesome. But the property itself, not a very good property. Old asset, 1920s. A lot of deferred maintenance. Old roof, boilers constantly going. It was just driveways, a lot of CapEx. So when you're looking at a deal, once you've selected the market, let's take a look at the property. Now, the caveat is pricing. When we started out back in 2011 buying these assets, asset prices were a lot lower. So you could buy these older assets and you could make them work because you could actually budget in for the CapEx, reposition these properties to almost new. You can change out roofs, you can change out flooring, you can replace the driveways, stripe and seal, new mechanicals. That can all be done when you're buying it for the right price. And you're repositioning this property. And we've done that several times on a lot of our properties. We bought a property back in 2019. I remember paying around $40,000 a unit for this property. It's well worth over $150 a door now. But when we bought it for $40 a door, this needed some massive heavy lifts. We did brand new driveways. We did brand new roofs. We did brand new interiors. Every interior was completely upgraded. Now that when we go in and we turn a unit, it's minimal turning because a lot of the work has already been done. But we were able to actually budget it. So as you're assessing a deal, we've looked at the market. We like the market. Now we're looking at the property itself. And it does come down to a function of price. What Jake and I have deferred to in this part of the market cycle. It's important. The properties we're buying, it's a function of market cycle. When we first started, properties that were older had much higher cap rates. They were cheaper to buy. You were able to fix those and flip those out. Now, where we are in 2025, you're going to see a lot of older assets. They're trying to sell them because they're stuck. They've overpaid. What do you call a 4 cap? That's 1970s built. You call it a foreclosure. And that's what's going on. So this part of the market cycle, the property to us makes a big difference. We're still looking at old properties if we can buy them at higher cap rates. If not, the newer assets are really, really, I think, desirable for us. I mean, the last four deals that we bought a 2001 build, a 2018 build, a 2019 build, and a 2007 build. And now we've got a 2024 build under contract right now. And it's because the market, number one, is phenomenal. And number two, that's what our buyer criteria has turned into, because we see there's more value in buying these newer assets. There's less capital expenditures. And we're buying them where there's operational value that we can add. We're not just going in there, and just trying to renovate units. That worked in the last market cycle. It doesn't work as well now. And as we enter the buyer's market cycle again, that will start working again. But right now, that's not where the value is. The value is in buying these newer assets that have some operational inefficiencies. These mom and pop landlords, their rents are still too low. They have to raise their rents, and their expenses are out of whack. So that's what we're looking at. Finally, the third one, you've done your due diligence on the market. Now you've selected your buy rate criteria on the property. Now it's time to start underwriting, and to me, looking at deals. The financial metrics mean a lot. But once again, the mistake that I was making early on, I was focusing on the financial metrics first, not caring about what the property's value or condition or the market was. Great. Everyone thinks that cash flow is the end all be all in multifamily. And I agree with that a lot of the times. Cash flow will get you out of your job. Equity will keep you out of your job. Now, what do I mean by that? Well, that deal that I bought in 2008, in Rochester, I paid literally $56,000 for it. In 2015, do you know what I sold it for? $60,000. I netted $4,000 in what? 8 years, 7 years? Okay, there's some principal pay down, a little bit of cash flow, because every time that unit went vacant, I'd have to reposition the unit, spend thousands of dollars. So over 7 or 8 years, I did make some cash flow, but I made no equity. Now let's look at the deal that Jake and I did, our very first deal in 2013. We paid $600,000 for that asset. Now we still hold it today. It's 2025. It's 12 years later. That asset easily, and maybe I can do this where I can chunk down the same time period that I bought the asset in Rochester, 2008 to 2015, that's 7 years. So if I look at the asset that Jake and I bought in 2013, if we make it to 2020, that's 7 years. 7 years. In 2020, that asset was comfortably worth $100,000 per unit. It was worth $2.5 million. So we paid 600, it's worth 2.5 million. We've almost got $2 million of equity in a deal. Great. Cash flow is great. We're making $7,000 to $8,000 every month on this deal. But over the span of 7 years, we made $2 million in equity. As opposed to, what do we make in the other one? $4,000. So cash flow is awesome, but equity is what makes you rich in this business. And selecting the right market that has the mix of cash flow and appreciation will make you exponentially much wealthier in this business. Now, when you're looking at the financial metrics, what metrics are you focusing on? Now, this is different for everybody. For Jake and myself, we've always focused on the profitability of the business. And you may be saying to yourself, well, cash flow is harder to get. And that's why we're not doing a ton of deals. We may do 2 to 3 deals a year, but they have to be really good deals, because 2 of our metrics that we focus on, that we love to focus on, are cash on cash returns and profit per unit. Last month, we had over $300 in profit per unit in our portfolio. It's a very important metric. Is that the metric you want to follow? Well, put it down. Cash on cash return. Another financial metric, this may seem silly to people, but we like to use the 1% rule still. If we can reposition an asset, especially these newer assets, if you're buying an asset for $180,000 per unit, and you can get the rents to the 1% rule, where your rents can come out to $1,800 per month, that's a really good metric that we like to see. If we can achieve that, that deal makes a lot of sense to us. So put down the 1% rule. See if that works in your market. See if you like it. I think the next one that all banks talk about is the debt coverage ratio. And most people got in trouble over the last 3 or 4 years is because their deals were not hitting a certain debt service coverage ratio. The money they were bringing in was just enough to pay the mortgage. Banks like to see a 1.25 debt coverage ratio. And there's only a couple ways for you to achieve that when you're looking at a deal. The first way is to drop the price. Or the second way is to put more money down. It's your choice. You either drop in the price. Well, if they don't want to drop the price, then you got to come in with more money as a down payment. And more money coming as a down payment, you know what happens. It dilutes your returns. Now, is that deal good enough still to do that? Depends upon what your metrics are and what you're trying to achieve. This next one is the IRR, internal rate of return. Jake and I don't use it because we're buy and hold investors. We don't have investors. It's our own capital. So we're less concerned with IRR and we're more concerned with cash on cash and the profitability of the asset. This next one is a cap rate. A lot of times we don't care about what the going in cap rate is because these assets are undervalued. It's not a true cap rate. It's not a repositioned cap rate. If you're buying a cap rate of, let's say, a 3 cap in a property that the market is a 5 cap, you're overpaying. But can you say to yourself, can I make that 3 cap and reposition it and push it up to a 7 cap and then decompress it or compress it back down to the market 5? That's one way of using cap rates. Knowing that when you're going in that you can increase that NOI, cap rates can be a good metric for you. That's not, once again, for us, the end all be all. We're not looking at cap rates because we know when we're buying a deal, we can add a ton of value. And I think this last one, depending on where you are or your journey, once again, what are you trying to accomplish? If you're trying to buy a deal in multifamily and you're trying to flip it, especially early on, the goal early on in your investing journey is to create equity. You're trying to get deals on what we call a conveyor belt, that imaginary belt where you're starting to put deals on. And as deals get on this belt, year 1, you're buying one deal. Year 2, you're buying another deal. So all of a sudden, you've got 2 deals in your portfolio. And as the time goes on, that deal is going to come off your conveyor belt. It's going to matriculate either through a sale, because remember, cash flow gets you out of your job, equity keeps you out. You're matriculating, you're pulling that equity out through either a sale or through a refinance. We've been able to refinance over $25 million off of our conveyor belt and repurpose them into different assets. So if you're starting out early in your journey and you're like, I'm going to be a buy and hold forever, I don't think so. I don't think that's the smartest thing to do. The smartest thing to do is to buy assets where you can add value, push up the value, either extrapolate that equity through a sale and buying a bigger property, or extracting it through a refinance, continuing to hold the property and reposition the assets. So profit flipping, looking at a deal, saying, hey, I can buy this deal for $1 million. I can add $200,000 into it. My after repair value is $2 million, but I'm into this for $1.2 million. I've got a potential profit of $800,000. Is that deal worth it? Now I'm looking at all the other metrics, right? Is the market good? Is the property itself good? Can I get it done with $200,000? And the financial metric of what's the profitability of that asset once I've created the budget. That's really important. So now to wrap this up, how to assess a deal. It's a very personal question. Everyone has different metrics, different, investing goals. Some may be here to preserve wealth. If you got $50 million and all you're looking to do is to beat inflation, your underwriting and your goals are a lot different than somebody who's 36 years old, hates their job, and is looking to create equity and get out of their job. So that's why it's important to, by assessing a deal, understanding what you're trying to accomplish. That's first and foremost. And then follow that framework of buy right, manage right, finance right, and then the market, the property, and the financial metrics. Look at those 3 on how you want to assess a good deal in multifamily. I want to thank you for taking part of your day to listen to how to assess a deal. It's such an important consideration when you're first starting out. I want to thank you once again, and I will see you on next week's How To. Take care, everyone.